Hey, what's up, stock compounders? Brad here. So it is that time of the week again for my weekly Q&A, all right? And boy, do I have a lot of Q's. So I better come up with a lot of A's. Let's jump right into this, guys. First question, how do Pabrai and Buffett run a simple DCF in their heads? They both always talk about it as if it's so simple and you shouldn't need Excel or a calculator, but never really provide an example of how they do that. Well, Pabrai has talked in the past about, say GraphTech, for example, looking at GraphTech, seeing, what the earnings are going to be over the next 5 years and realizing, hey, if I bought the whole company, I'm going to make my money back within 5 years. And then everything past 5 years is going to be gravy. And that's only the contracts that we already have locked up. Now, of course, GraphTech, didn't quite pan out the way that Pabrai was expecting. But that's, I think that's how both Pabrai and Buffett approach this. It's that simple. What do I think the company is going to earn in the near future? And is that going to pay me back based on what I'm laying out now? Now, that's kind of a discounted pie way to look at it. Buying with a big margin of safety. I'm curious to hear from Pabrai on, how he's doing the math in his head now that, he's focused more on growth companies, more on these long-term compounders. But that would be a very interesting question. I hope someone asks Pabrai that in one of these, university Q&A sessions. Thanks for that question, Shane. Tom. Would you rather be gifted $100,000 of Berkshire or $200,000 of Tesla? The only rule is it's locked up for a decade, okay? I like this question. So the way I thought about this question, two things. First, I think Berkshire is just about fairly valued right now. I think Tesla is like 5 times overvalued, according to what I would be willing to pay for Tesla. So based on that, if I only get half as much in Berkshire, that's okay, because I think Tesla is 5 times as expensive compared to what it's worth. So I would take the Berkshire. The other way I would answer that is I don't think I quite have the temperament to own a company like Tesla, right? To have my capital with Elon Musk and, his shenanigans. So, I'd be happy to own Berkshire. It's possible in 10 years I'd come out a lot better owning Tesla. I don't know, obviously. But still, I think the ride would be a lot more stressful. And so I'd be happy to own Berkshire. Thanks for that question, Tom. Is what's taught in Aswath Damodaran's classes basically the same as how Buffett, Munger, Pabrai, Li Lu would value a company? I see his 2-hour-long classes posted on his YouTube channel and wonder if it's worth the time to learn such in-depth valuation. A great question. I have a lot of respect for Aswath Damodaran. One thing about Aswath, when he runs a model, when he does a valuation, he has so many inputs, right? Like it's crazy. It's quite intimidating as someone new to doing valuation work, and my gut tells me it's overkill. Okay, a lot of these great value investors talk about how there's really only 3 or 4 things that are going to dictate how a company does over the next decade, 2 decades, how great of an investment it's going to be in terms of looking at the financials. So to me, it's overkill. I have a hard time recommending it to people because, Damodaran, he's an academic, okay? And I don't mean that as an insult to him. That's what he does. He teaches valuation. And so when you teach valuation, you've really got to get into the details of valuation. When you're a practitioner, you don't really have to get into the details. You're looking for the fat pitch, okay? The numbers that are so obviously compelling, that, you're throwing your money at the company, right? And that's not the game that DeModern is playing. It's just coming at valuation from a totally different perspective. So, I probably wouldn't recommend getting into, what DeModern teaches unless you're going to university, right? And you want something to study, you want to be an investor. In that case, it's probably worth going through that program just to get a deep knowledge of, how do you look at a company's financials? How do you think about the story? But probably better to just learn directly from some great value investors like Pabrai, who gives, a handful of talks each year. Like Li Lu, who's put out a few books. If you can find translations to English of those, I think those are probably better for most people. Most people are going to get more value out of that approach than DeModern's valuation courses. But great question. Mr. Pink, why do you not clone Warren Buffett during these times? Buffett has been described as the best known business analyst. The main reason I don't clone Buffett is because he's just running so much capital, right? What is it, $500 billion Berkshire Hathaway is valued at? So there's so many things that Buffett can't buy. He won't even look at because they're too small. Berkshire can't put a meaningful stake in those businesses unless they're like, maybe one of the 100 largest companies in the U.S. or, same with companies overseas. So it's just so limiting. And, I'm not running a ton of capital, so I don't want to limit myself in the same way that Buffett is limited. So that's the primary answer I would give to that. Now, I may be wrong. It's possible, Verizon is just going to do very well over the next decade. And I'm silly not to buy Verizon just because I don't want to clone Buffett because I think he's managing too much capital. So I'm not going to fault anyone for cloning Buffett, but I have a sense that I'm going to generate better returns. I'm going to do better as an investor managing a smaller amount of capital by looking at smaller opportunities, smaller businesses that still have a lot of room for growth. So it's a great question, though. And again, I may be off on this. I may be wrong to be excluding Buffett from kind of the shameless cloning approach here. Brian, you've spoken about having young kids. Yes, I have 2 very young kids. I'm interested to know if you've learned anything in your investing education that has helped you be a better dad, and anything from being a dad that helps you be a better investor. Thanks for your awesome content. That is a fantastic question. Investing teaches me patience. That's really one of the easiest ways, the surest ways to outperform is by being patient with my positions. So, having kids, patience is an absolute requirement. And it's interesting, time kind of gets distorted with kids as well. It's this weird kind of time vortex. I think that's the main thing is patience. Sorry, I don't have a richer answer to that one. I do like the question there. Vic, hope you're well. I am. Have you added to your position in Shinnikin? If not, what's holding you back? I have not added to Shinnikin. Like I said, I set up an account for my daughter who's almost 6 months old. She's got $1,000 in Shinnikin. I wish I had $1,000 in my investment account when I was 6 months old. That would have been fantastic. The bulk of my portfolio is in TD Ameritrade, and I have some in Robinhood. And I haven't moved things over yet. I don't know if I'm going to move things over. It hasn't been a great experience with Interactive Brokers. just not having anyone that I can really call. The customer service is just sorely lacking. So I'm not sold on moving everything over to Interactive Brokers. I'm kind of taking my daughter's portfolio for a little bit of a test ride here to see how that goes. So that's the main reason. I probably would have bought more Shinnikin if I had my portfolio with Interactive Brokers. And I'm still learning about the company. Just kind of took a bite-size position there with her portfolio. So to be determined whether I'm going to keep adding to Shinnikin or not. How did you first get into investing? Did you read some book or an article? Did some acquaintance tell you about it? Did you have some free cash and wanted to do something or whatever else? So, for most of my life, I've had kind of a relationship with money that was challenged. Okay. I had all these beliefs about money, relating back to my relationship with my dad. He wasn't around that much growing up. It felt like he was spending a lot of time at work. He's a financial advisor. So, it really felt like he was prioritizing money for our family, right? And from my perspective, maybe a little bit at the expense of our relationship. At least that's kind of what I saw as a child. So there's some stuff I'm still working through, but I've had to work through around money. And I read, what was it, like 5 or 6 years ago, probably 6 years ago, I read Tony Robbins' book, Money Master the Game. And that got me really interested. I mean, I think I was already interested. That's why I found that book. But it was interesting to hear it through, somebody that I respected, kind of as a self-help professional. So I read Money Master the Game. Not much of the stuff in there quite resonated with me. It seemed like a lot of the, efficient market theory, kind of the common advice you get around investing. It just didn't feel quite right. But one thing that stuck out to me was Ray Dalio in there kind of came up with this all-weather portfolio. And I think it planted the seed of, oh yeah, that makes sense. If I want to learn how to invest, figure out who's crushing it in the investment world and do what they're doing, right? The shameless cloner in me was born. But Dalio wasn't quite right for shameless cloning. I mean, it's just such a diversified approach. And then I found Pabrai. I think Pabrai was one of the early ones that I found in the value investing space. Much easier to clone because Pabrai never really has more than 10 positions, at least in the US. So that's kind of where I started, just watching videos about Pabrai and what his approach was. So, that's kind of a medium, not a short answer, not a long answer, but that's kind of where it started. Bro, at what age would you stop looking at stocks to purchase? And when that happens, where would you look to invest? So I'm not totally sure what you mean by this, bro. Like Charlie Munger, Warren Buffett, they're still picking stocks. I don't know that I'm going to get to an age where I stop looking at stocks. It's possible sooner than later. I even possibly I may just go to a shameless cloner portfolio where I set up the rules and then I just follow the rules. So there's not much business analysis going on, but I'm enjoying learning about businesses at this stage. But I don't really have an answer to that. I'd say as long as I'm enjoying it, as long as I'm enjoying learning about different businesses, I'm going to keep looking at stocks to purchase. And I don't know, maybe real estate could be something I get into in the future. Multifamily, something like that. I've done some stuff on that in the past, some training around that in the past, and that's compelling as well. Looking back since you started your YouTube channel, are there any investors that you admire more today, and are there any you admire less? I think Li Lu, as the more I learn about Li Lu, actually posted a video a while back with the documentary about Li Lu, Moving the Mountain. Check that out if you guys haven't seen it. It's just incredible what Li Lu has been through in his life. So Li Lu I admire more. Any admire less? No, not really. I can't think of anyone that would fit that bucket. Frank, if you could do a weekly live stream with 4 other YouTubers, who would they be? That's an interesting theoretical question, Frank. A few come to mind. Investing with Tom would be one. Karan would be another one. Jack Duffley, I've been a big fan of his work, big up-and-coming YouTuber. And I can't remember the 4th one right now, Frank. Let me see if I can remember before we finish the Q&A here. But that's an interesting question. I wonder about that. Retro Ranger, when does your infamous watch list video come out? Will this be like Duke Nukem Forever announcement? Yes, the watch list video. I'm Monday or Tuesday, I believe I will be putting out the watch list video. So keep an eye out for that one. I've been, just kind of sitting with it all. I want to make sure these are really, I've got all these companies in my sights here for you guys before I release that. Drew, have you ever tried drop shipping, affiliate marketing, etc.? I have tried affiliate marketing probably a decade ago. I made a video, it was like an hour long, of how to build a website using WordPress, some plugin on WordPress. And I was trying to, generate some affiliate money through Bluehost, okay? I don't think I ever got $1 for that. And here's the thing I'm going to say about drop shipping, affiliate marketing. If it seems like it's going to be an easy way to make money, chances are you're not going to stick with it long enough, or you're not going to do what needs to be done in order to make it successful. Okay? That's a great lesson to learn. If it seems like easy money, you're going to find out it's not actually easy money. Because if it were easy money, enough people would do it so that it's no longer easy money. It kind of shifted my mindset around. Now I'm in more of a, get rich slow mindset. Get rich slow, but for sure. Okay? And that's really what compounding is all about. You're doubling every period of time. And it feels slow at first because doubles, when you start with a small amount of money, or you start with a small number of subscribers, the doubles really don't seem like much, okay? But there comes an inflection point where it really starts to take off. And that's kind of the groove, kind of the mindset I'm adopting, both for the YouTube channel and for my investment portfolio. So learned a lesson there. Marco, if you could get rid of one bias or flaw in human thinking, what would it be? Thank you for publishing such wonderful content. Thank you, Marco. So one thing I've been thinking about lately is, and this is something that Tony Robbins says a lot, there's what happens to us in life, and there's how we respond to what happens. Now, usually what happens to us is outside of our control. I mean, largely, we don't have a lot of control over what happens externally to us in life. What we do have control over, but what not everyone realizes that we have control over, is how we react to it, how we respond to that, how we let that external thing impact us. So if people could really get that, I think that would be huge for a lot of people to have that shift, rather than dwelling on circumstances that we find ourselves in life. accepting the circumstances and, you know, taking responsibility for them to, you know, get out of them if we need to, or do what we can do to find happiness. And I think that perspective is hugely valuable. Of course, it's not just Tony Robbins who talks about that. It's rampant. There's a lot of people who are aware of how powerful that shift is. Henry, what is your strategy on holding shares? You have done a thorough deep dive into a company and it's reached a price that you are comfortable paying. Okay. Do you have a sticker price in mind that you were happy cashing out at and looking for a new opportunity? Or do you let it ride long term, say 10 years or more? So this is something that's shifted recently for me. I used to kind of have an idea about what I thought was a good exit point. These days, I'm really looking for companies that I want to hold on to for a long time, okay? And I really like what Pabrai said about this, and I think Charlie Munger said something similar about this. If the business is getting better, okay, assuming you're owning a great business, right? You're investing in the business because, you know, it checks all of these boxes. It's a great investment over the long haul. If the business is getting better, forget about the price, okay? Forget about the price. Let the business make you wealthy. Let the business compound your wealth for you, okay? We often do ourselves a disservice as investors when we tinker with the portfolio, okay? We try to get in and out and, you know, outsmart ourselves effectively. So I'm more, you know, that's not saying trading doesn't work. It works for some people. My temperament is such that I want to buy a company and I want to ride that company off into the sunset. So that's where I'm at these days. 10 years or more would be great, assuming the company keeps getting better. There aren't probably that many companies that are going to get better and better and better over a decade or more. And if that's the case, if they're not getting better, you know, sell it off, and hopefully you can find one of these that's getting better and really double down on those bets. How frugal are you outside of investing? I think I'm pretty frugal. I mean, I drive a 2012 Honda Civic compressed natural gas vehicle. So very cheap fuel, very economical car. I make my own coffee. I don't eat out. I mean, obviously we're in COVID time, so it's a lot harder to eat out. But, you know, I make most of my food at home. I don't go on these lavish vacations. So I think I'm pretty frugal. You know, actually, that's an interesting question because just recently I'm looking through my credit card statements and, you know, getting clear on where all of my spending is going so I can ratchet down even more to try to minimize that unnecessary spending. But, you know, I like to have fun too. I'm not a cheapskate in terms of experiences in life. I'm a cheapskate in terms of paying for investment services. Like I'm not going to pay for the acquirer's multiple, you know, entire stock universe screener or anything like that. But so I do consider myself frugal. Can you share some light on your investment checklist while doing due diligence? So that's a bit of a longer conversation. Let me know if you guys want me to make a video about that in depth. Nicholas, once you estimate intrinsic value or decide on a price target, how long are you prepared to wait for the gap to close before you move on to a new idea? Well, I like what I think Joel Greenblatt said in his book. I think Pabrai has said something similar. If the gap hasn't closed in 2 or 3 years, you probably made a mistake in terms of the valuation work that you did on that business. So, you know, 2 or 3 years might be a good point to cut your losses and move on from a company. But that's not always the case. I think it's a good rule of thumb. When you start a position, do you go all in or divide it up? Thoughts? It really depends on my level of conviction. If I understand a business, right, and I understand that it's a screaming buy, I'm not going to wait. I'm going to put my 10% down or 20% down or whatever I'm doing in the moment in terms of a full position. But if I don't really understand a business, I'm fine kind of putting a little bit in so I can kind of look at it as an owner. I think that can be helpful. So yeah, that's how I would answer that. It's all about conviction. Yeah, we'll leave it there. What are some of the lesser known top 5 book podcast recommendations? So I don't really have any regular podcasts that I listen to. Let me know in the comments if you have any great kind of investing or, could be even more than investing podcasts that you guys listen to. Books that kind of go under the radar. 100 to 1 in the stock market, which was something Pabrai recommended in his last couple talks at universities. That's kind of the precursor to 100 Baggers, which is a book I reference often. Anything else lesser known top 5 books? That's something I'm going to have to kind of think about. Maybe I'll put out a video about that as well. Your thoughts on investing SIP in top 10 stocks of S&P 500 for long term. I'm not convinced that investing in the top 10 stocks of the S&P kind of monthly or quarterly would be better than investing in the S&P 500. I'm curious to hear your thoughts on it sounds like you think maybe that would be the case. Curious to hear why that would be. My sense is I wouldn't necessarily want to invest in the biggest companies in the U.S. Because, it seems like over time I've seen studies where small caps outperform large caps over a long enough time horizon. You've got more volatility, but you do have outperformance. So, I may be more inclined to look at maybe even the bottom of the S&P 500. But I wouldn't do that. I would look at small caps, maybe even micro caps, and do some kind of strategy there. What would be more compelling right off the top of my head is just look at magic formula each month or each quarter, however often you want to invest, and just pull out the smallest cap magic formula stocks. And you could apply additional filters if you want to invest the time with insider ownership and, is there a value investors club write-up, all that stuff. But this doesn't intrigue me very much, the idea of investing in the biggest 10 S&P 500 companies. Is a tech company a good price just because PEG is less than 1? I'm thinking Qualcomm and Facebook. Assume reasonable grasp of the business story. So PEG isn't really a metric I've used. Part of that is because, I'm kind of new to the growth game. I haven't really, I've historically been looking more at value than at growth in terms of, cheap businesses versus fast-growing businesses. So I don't have experience looking at PEG, but my gut is I wouldn't say a company is good or an investment is good just because of one metric. I think that's probably an oversimplification. So I think what PEG is price over earnings growth, which obviously is a compelling metric for looking at growth at a reasonable price. So could be interesting. But sorry, I don't have more thoughts about that one. George, how do you find the time for work, family, YouTube, investment research, etc.? Any advice for someone with very average time management skills? So I will admit to having very average time management skills. Okay, I do not have. I mean, they've gotten better as I've had kids out of necessity, but really I just chunk it up, right? So, work is a little lighter. Like I've said this before, I do some landscaping work, but it's been less with the pandemic. There hasn't been as much work. YouTube, I kind of just I kind of merge YouTube and investment research. They go together, and I like what Gary Vee says about this. Don't think of yourself as being a creator, okay? If you're on YouTube, if you're trying to grow a channel or whatever other social media platform, the idea of creating content, that sounds like a lot of work, and it can be a lot of work. But what Gary Vee does, he just documents, okay? He documents what he's doing on a daily basis and just finds the content within that. He has someone follow him around with a camera all day, okay? And then just kind of pulls out clips to create content. So, and I do something similar. I make YouTube content based on whatever I'm into, whatever I'm learning about investing. So those kind of go together. And then family, sorry guys, I got to refresh this bad boy. Thank you, Apple. I can't blame Apple totally. I mean, I should probably take better care of my computer, quite honestly. So, yeah, it's tough. There's a lot of days when I'm like, I wish I had more time. But, at the end of the day, it's you get done what you prioritize, okay? And, I think I'm doing a decent job of prioritizing all of these things. So, I don't know. Yeah, I don't have any great insights there. I'm probably not the one to be offering advice on time management. Why are you bullish on Manish Pabrai? How do you determine which guru investor to follow? I'm bullish on Pabrai because I really understand his framework for investing. And the reason for that is he puts out so much content. You can really get in his head when, if you watch video after video, Q&A after Q&A of Pabrai. So that's one thing that really makes me feel comfortable with him. And I've seen he's had some great investments in the past, and he's very willing to share the lessons from that. He's also willing to share the lessons from the investments that haven't gone well. How do I determine which guru investor to follow? Really, it's, part of it is which gurus Pabrai follows. So every quarter, Pabrai, he says it's an orgasmic experience to look through the 13F filings of all of these great investors, right? So, I'm looking at a lot of who Pabrai looks at. Li Lu, I've done some digging on him. I'm pretty comfortable with his process. So it's really just about, which super investors, which great investors have a framework for investing that kind of fits your temperament, fits your style, resonates with you. So that's what I would say about that. It helps that Pabrai just puts out a lot of content. He puts out a lot of teachings about investing that really makes me gravitate towards him. And it makes a lot of sense, right? It's very, it's very intuitive when he shares something. It's like, oh yeah, that feels right. It not only makes sense, but it feels true. How to size the allocation for a particular stock from the cash we have ready to invest. For example, if I have 10,000 cash and I find 2 stocks on discount, how should I allocate cash to each, and how much stays in cash, if any? Similar question, how does Pabrai and Buffett decide how much to trim and or add? Well, Buffett, I don't think Buffett and Pabrai do a lot of trimming. I think adding is kind of when it gets back down into that buy zone price. I mean, I know Buffett has been taken a little bit off of Apple recently, but I think that's kind of an unusual thing for him. So how to size allocation? I think the best way to size allocation is, decide how many stocks you want to own, and then you just chunk it up, right? If you want to own 10 stocks, you put 10% of your cash, or I would look at it as my total portfolio value. Okay, 10% of the total portfolio value into each idea. If you find 2 stocks on a discount, how much should go into each? It really depends on how bullish you are on each one. Probably one of those you're more excited about. You think the long-term prospects are better than the other one. So, I don't know, there's really no magic pill. There's no magic formula for deciding how much to invest in each one. It's really just kind of doing it and getting to know what you're comfortable with as you go along. Yeah. It was interesting. Sven Carlin put out a video recently. I think he said he has no cash. He's fully invested. Okay. And that's really where he likes to be. So you might glean something from that video that he put out. Jordan, curious what you get on a basic DCF on Ruger, if it's on your list. Did some calculations since they are close to margin of safety, but the DCF made it look like a home run with the current price. I think my WACC is way off, perhaps. Just a thought. So anybody who has access to the Rule 1 calculation, I don't know if Philtown has updated that to include kind of the owner earnings calculation, payback time, and margin of safety. But if anyone has access, do a quick run on Ruger and let us know what you find in the comments. That would be fantastic. I haven't done a deep dive on Ruger. I own it in my Test Magic Formula portfolio, but I haven't looked into it. It's not really a company that I'm interested in doing a deep dive on. I'm not really a gun guy. It's not a business that really interests me. So that's how I answer that one. What do you think of Twitter as an actual investment? Ooh, a little foreshadowing here. So Twitter will be on my wish list. Okay, that's all I'm going to say. Keep an eye out for Twitter. And I'll probably do a deep dive on Twitter in a future video. GARP investor, do you have a buffer on your DCF purchase price to current share price? For example, company X has been calculated to be worth $50. Current share price is $53. Do you buy? Yeah, that's a tricky one. It's possible that I kind of take a starting position. If it's one of these great long-term compounders or has the potential for that, I may not be so nitpicky about a price difference like that. Yeah, so there's no magic in terms of rule of thumb with that one. But I don't usually think about having a buffer. Historically, I've been pretty stingy when it comes to, here is my buy price. It needs to be below that for me to be interested. I think I'm loosening on that as I kind of learn more and more about, this concept of anchoring and not wanting to be so fixated on needing to get in on a certain price if it's a great long-term potential compounder. So trying to loosen up around that a little bit. How is your search for microcap fund managers going? Not that well. I still have to go through a number of videos where in the comments a bunch of you guys gave some ideas about which fund managers to look at in kind of the smaller business space. I just put out a poll on my community tab asking which investors you guys like to clone. So definitely, if you have any fund managers that really kind of focus on smaller businesses, please let me know in the comments in that poll so I can kind of put all those together and create kind of a master list of potential cloning targets. That is a top priority for me to put that together. Do you think Eddie Lampert is getting out of SRG? Looks like he sold 7%. So Lampert has been selling some SRG over the last couple of weeks. I think he sold, what did he sell? I think it was like $11 million or something. But you've got to remember, Eddie Lampert owns a lot of operating partnership units for Seritage Growth Properties. And it's easy to kind of lose sight of those because they're not always kind of listed with number of shares outstanding. So it's a little complicated. I think he's only sold about 3% of his position in SRG. And like Pabrai says, there's 100 reasons an investor sells stock, okay? An insider even. There's only one reason they buy. And that's not entirely true. You know, sometimes insiders buy because they want to make it look like they're bullish on the company to get more people to buy. It can be a buy signal for other investors. But primarily the only reason an investor buys is because they like the investment opportunity at that price. So I don't think he's getting out of Seritage Growth Properties. I think he just needs cash for something. That's my take. But if any of you guys have a different take, let me know. A comment, yes, please. You mentioned how it's easier for you to listen to audio than read lately due to family obligations. Yes, it's harder to find time to sit in front of my computer, but I can always have some earbuds in listening to something. Well, not always. A lot of the time, that's possible. There's a podcast you may have already come across, The Memo, where Howard Marks discusses some of his newsletters. So I haven't heard of that. That's awesome. I love Howard Marks. I will check that out. Really appreciate that suggestion. What tools do you use to follow what super investors have invested in? For example, how do you get updates, alerts when they file a 13F or take a position? Also, do you pick your own stocks via value line sometimes? So I don't have, I'm a little embarrassed to say this, I don't really have a system in place to get alerts when there are changes for gurus that I'm tracking. I think Tom, I think he has something set up. It sounds like he got an alert recently that Eddie Lampert was selling some shares of Seritage. So ask him, ask Investing with Tom. I should probably ask him as well. One thing that's awesome about this channel, like 6 months, it's probably less than 6 months ago, I put out a wish list, right? And, you know, I didn't have any alerts in place for that wish list. And you guys are awesome because right when Alibaba got down to that price I had specified in my wish list, you guys were like, hey, are you buying Baba? Like it's down to your buy price. And I'm like, thank you. So I have a built-in alert system with this community, which is fantastic. But I probably should get a little bit more systematic about alerts and whatnot. So thank you for that nudge. Do you pick your own stocks via value line sometimes? I've never found a stock via value line that I've invested in. At least that's not where it's originated. And really, the more I learn on this investing journey, the less interested I am going outside of what gurus own, what super investors own. There is so much value to knowing that a great investor has already vetted the company, okay? Now, we don't know how they vetted the company. We don't know the work that they've done. All we know is that they bet with their dollars on that company. But that's a big deal. That is fantastic that we have access to that. So honestly, I'm not super interested in going outside of that. I think the main reason I would go outside of that is just to feed my ego, to say, hey, I found this company in some corner of the market and I bought it without any help from these incredible investors. Well done, Bradford. Well done. I don't care. I don't need that ego boost of finding my own things. Okay, so I think it's a crutch often when investors feel like they need to do all of the work themselves. They don't want to copy or even get ideas from other investors. I think that's a mistake, at least in terms of growing wealth over time. Last question. Hi, Brad. Hope you're doing well. Thank you. I am immensely thankful for your videos. Fantastic. The journey so far has been enlightening. The question I have, it is said we should sell our stock when there are some fundamental changes in the company. I think Phil Town says this. Do you think Alibaba presently falls into that category? I do not think that Alibaba presently falls into that category. I believe their financials are quite strong. Could you please shed some light on the fundamental changes that may make you sell shares of a company? Have you come across any similar situation? So the one that comes to mind is Fiat Chrysler, okay? Manish Pabrai got into Fiat Chrysler, primarily because of Sergio Marchionne, okay? Sergio, fantastic CEO. I don't know if there have been books written about Sergio yet, but there will be books written about Sergio and what he was able to do with Fiat Chrysler. Now, tragically, a couple of years ago, Sergio died, okay? Now, when Sergio died, Pabrai, I was sure Pabrai was going to sell out of Fiat Chrysler because that was such a big part of Pabrai's thesis, why Pabrai was bullish on Fiat Chrysler. Now, Pabrai didn't sell out, okay? And I think there was some emotional reason that Pabrai didn't sell out. Like Sergio was so dedicated to this company. I mean, he didn't even tell anyone that he was dying until it was like a week or two before his death. He resigned from Fiat Chrysler. And there was something about that that really captured Pabrai, and there was an emotional hook in Fiat Chrysler for Manish Pabrai. So that's a fundamental change. When a CEO of that caliber is no longer running the company, that is a fundamental change that should get everyone's attention. And so that's an example that I'll give there. So that's it, guys. That was fantastic. 32, I believe we had 32 questions in this episode. This is by far the longest Q&A I've ever done, I'm pretty sure. So keep them coming. I'm happy to do long Q&As. These high quality questions are just really fun to answer each week. So please keep them coming. I wish you all well and happy compounding. See you all in the next video. Take care.